Thank you for watching this video. Today we will be doing technical analysis on the stock market for the week ending Friday, January 8th, 2021. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is a stock market risk management and trend direction model. Let's start off with the S&P 500, and for today, Friday, January 8th, the S&P 500 was up 55 basis points, and we closed at a new all-time daily and weekly closing high of 3824.68. The first chart that we're going to look at is a 15-minute to 15-day candlestick chart of the S&P 500. The blue horizontal line is set at 3,700, and you can see here up to this week we were trading around this 3,700 level, just kind of slightly above or below it. Monday we gapped up at the open and then sold off pretty hard on Monday. Monday this week was the only day that the stock market, the S&P 500, was negative. But you can see from Monday's lows where I've drawn this trend line, look at this trend that we had starting on Monday's lows for the rest of the week. This market has just been so resilient, it's almost unbelievable. But I am starting to see some signs of froth, which I'll talk about more throughout the video here. But the markets have been tremendously resilient, guys, but at some point, we will get a pullback, right? So just be prepared for it. But again, Friday the 8th, we were up 55 basis points, and we closed at a new all-time daily and weekly closing high of 3824.68. The next chart that we're going to look at is a one-year weekly candlestick chart of the S&P 500. The blue line is still set at 3,700. And we can see here that for the week, the S&P 500 was up 1.83%. And this is the first week in the history of the S&P 500 where we have closed above 3,800. And you can see that we've only had a few weeks where we've actually closed above 3,700. And once we got up above that, that 3,700 level towards the tail end of November, we traded tight against that line for about 4 weeks. Of course, last week closed above it. And then this week, we've gotten ourselves above 3,800. So these markets have been absolutely unbelievably resilient, perhaps too resilient. When it gets too good, right, you have to start, preparing yourself for the potential pullback that might be coming our way here. So, yes, things are going quite well, but perhaps things are, too good. And we just have to be aware of that. And I'll talk more about some of the froth and things that I'm seeing in the markets once we hit the next few charts. The next chart that we're going to look at is a one-year weekly candlestick chart for the Dow Industrials, and the blue line is set at 30,000. The Dow was up 1.61% this week, and we closed at 31,097.97. So that is a new all-time weekly closing high for the Dow, and this is the first week in the history of the Dow Jones Industrial Average with a close above 31,000. It wasn't that many weeks ago that we had just traded above 30,000 for the first time. So, and you can see that once we got up to that level, kind of in the middle of November, we traded tight for about 6 weeks, kind of sideways. But over the last couple of weeks, we've been able to creep ourselves slightly higher. But another really nice week in the Dow, up 1.61%, and again, a new all-time closing high of 31,097.97 for this week. The next chart that we're going to look at is for the triple Qs. Of course, the triple Q is the ETF that tracks the Nasdaq 100, and the triple Qs were up 1.70% this week and closed at another new all-time high. 319.08 is the exact number there that we closed at for the week. One of the things I want to point out here is that we are now trading right at 20% above the 40-week, equivalent to the 200-day, of course, moving average on the triple Qs. Now, It doesn't mean we have to pull back to that 40-week moving average anytime soon, but, whenever you're trading that far away from a long-term moving average on a large basket of stocks like this, right? There's 100 stocks in this in this ETF, the Nasdaq 100, the triple Qs. Whenever you're trading that far away from a long-term moving average with that many stocks, it just makes you vulnerable to a pullback. And keep in mind that a bear market on anything is when that investment is trading 20% or more below its all-time high, its most recent all-time high. So at this point, if we were to just pull back to the 40-week, the 200-day moving average on the triple Qs, we would technically be in a bear market on the triple Qs. So it just shows that these markets have really run a long way in a short period of time. And it's good to be aware of this, right? The triple Qs, right? A lot of really fast-growing companies in that investment. It's been one of the hottest areas of the stock market for several years. So, it doesn't mean it has to pull back to the 40-week, the 200-day moving average anytime soon. But just be aware that, there's some froth out there, guys. And speaking of froth, a couple of things here. The markets are priced for perfection, at least in the short term. So I think we're vulnerable to some type of a shock, an unexpected event, or a disappointment. It doesn't mean it'll come, but if there's some, and it doesn't have to be a black swan, right? When things have gone this well in the stock market in such a short period of time, and we're trading this far away from some of these long-term moving averages, any little thing could cause the market to pull back, okay? And there's also speculation, guys, and stay with me on this because this is super important. There's speculation like I haven't seen in 20 plus years. In some respects, it's starting to feel like the late 90s, early 2000s to me. And I'm not the only one that feels this way. When I talk to a lot of my subscribers, my friends that are in the, and subscribers that are in the financial services profession, they're saying the same thing. As a matter of fact, one of the things that I saw today, and I'm not going to give you the ticker symbols because I don't want to encourage anybody to go out there and do this, but I found two different stocks just today, just on Friday the 8th here, that were up over 50% just today, not for the year. They were up 50% today. Okay, these are penny stocks. Penny stock, of course, is anything that's under $5 a share. These are cheap stocks, penny stocks. Neither one of these companies have earnings, right? They're still losing money. Neither one of these companies, in my opinion, had an attractive business model. But in both cases, guys, and this is what's really key, not only were they both up over 50% today, just today, but in both cases, these companies traded at least 2 and up to 4 times their float just today. In other words, and I'm just going to give you an example, if there's 50 million shares afloat, right? That's the float on the company, 50 million shares. In this example, and I'm not going to give you the exact numbers, but it was anywhere from 2 to 4x. These companies, both of them, traded at least 2 times their entire float, 100, so in the example that they have 50 million on the float, these two companies traded at least 100 million up to 200 million in today's activity. So we're seeing a 2 to 4x turnover in the entire float of the company in one day on these penny stocks that have no earnings, that have mediocre business models, in my opinion, and these things are up 50+% in one day. Come on, guys. That's not right, okay? That is not normal. You do not see that in a normal market. So this is the type of thing that I'm seeing out there. And when you start to see that, it just shows that there's some speculative fervor that's out there that it's not sustainable and it's not healthy, okay? So just be aware of that. And I would encourage you guys to have a rock-solid risk management system in place that helps you cut your losers and let your winners run, okay? And a good system will be as valuable on the way up as it is on the way down. In other words, it'll help you understand when the trend of the market and when it's safest to be in equities, right? Irrespective of maybe headline risk or anything like that, but also it will help you understand when risk levels start to change, where you might want to take some profits, rebalance, pare back a little bit, okay? So with that said, if you are a financial advisor or an individual investor who runs any of your own money, including in a 401k or your IRA, I encourage you to pay close attention to the balance of this video. I'm going to tee up some information about my system that I created. Took me over 20 years to develop this, guys. Okay, 20 years of hard work, trial and error to come up with something that helped me, even with my background, minimize my emotion and keep me in sync with the markets when the market was going up, down, or sideways, right? So I'm going to tee up some more information about this. It's called Simple Market Signals, but please pay close attention to this because the next part of this video can be extremely valuable to you going forward, whether you're a financial professional or a serious individual investor. Let me ask you a question. Do you have a stock market risk management and trend direction system in place? Do you know the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the trend of the stock market? My system is Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecast, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including numerous bull and bear markets. And what I found is that certain conditions exist during various market phases, and then I created simple, easy to understand signals around these different phases of the markets. And the thing is, guys, that most people don't know about or have access to the data necessary to do the research that I had to do to create this model. Simple Market Signals is a proprietary stock market risk management and trend direction model. And Simple Market Signals is perfect for financial professionals and individual investors. There's two major components to the proprietary model. There's a risk level signal and there's the general trend indicator. Let's start off with the risk signals. The risk signals are simply green, yellow, and red. The green signal has the lowest equity risk associated with it. And what you're going to find is that most all upward progress in the stock market will be made in a green signal environment. Said another way, it is hard to make money in equities unless the signal is green. The yellow signal means there's moderate equity risk, and sideways to slightly up or down price action is very common during a yellow signal environment. The red signal has the highest equity risk, and the worst sell-offs, including bear markets, will happen when the signal is red. Okay, a quick refresher on the Simple Market signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th. And then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal. We had the general trend indicator went negative. And then we had the risk signal went red on the 27th. That was Thursday. All right. And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. And we can see here that the market fell from there. These signals are delivered to subscribers in our weekly emailed newsletter. As part of the Simple Market Signals weekly newsletter, you will receive the proprietary risk level signal and charts on the overall U.S. stock market. You will also receive the general trend indicator signal and charts on the overall U.S. stock market. You will also receive a weekly recap of what happened in the U.S. stock market, including performance information and charts. And this is on multiple investments. So we cover small caps, mid caps, large caps. So you'll have a great idea of what's going on in the entire U.S. stock market across all capitalization. You will also receive technical analysis data and charts, so things that are interesting and educational that I think is important for you guys to know will be included in the newsletter on a weekly basis. You will also receive fundamental analysis data points on the S&P 500, so we look at potential earnings per share for the year, as well as the possible PE ratios and then price levels looking out to the end of this year, and then I generally go out to the end of the next year as well. So you'll have great fundamental analysis data to work with on the S&P 500 right at your fingertips every single week. You will also receive yield curve information and data points. So we look at the 2s and the 10s. So the 2-year Treasury note, the 10-year Treasury note, and then the spread, the differential between the 2s and the 10s. This information, guys, very few people know about it. Very few people watch this. This is so important to really get your head wrapped around because it affects so many areas of the financial markets. And you will also receive the proprietary risk level signals on all 11 major sectors of the S&P 500. So not only do you get the risk level signal on the overall market, but we also give you the risk level signal on all 11 major sectors of the S&P 500. So you can see what the risk level is underneath the hood on all of the individual sectors. And you will also receive sector performance information on all 11 major sectors of the S&P 500 over multiple time frames. So guys, you're going to get all of this, right? And it's going to make you so much more knowledgeable about the financial markets. You're going to be able to have a conversation with virtually anybody about the stock market, and you're going to be able to really understand things at a level that very few people do. And guys, you're going to get all of this for just $19.95 per month. That's less than 67 cents per day. I want to set realistic expectations. The weekly emailed newsletter isn't fancy. It's effective. It's plain text, no color, other than the charts, of course, and no fluff. But it's chock full of extremely valuable information week after week. And please note, due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. Sign up is quick and easy. Just go to simplemarketsignals.com. That's https://simplemarketsignals.com. It'll take you about 4 or 5 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now let's recap what you will get with your Simple Market Signals subscription. With your subscription, you will receive the weekly email newsletter, which goes out on the weekends, that will include all of the content that we just talked about. Plus, you will receive midweek update emails when warranted. So if there's a major signal or trend direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to send a midweek update email to get you that information as soon as possible. What is it costing you to not have this information? And also, what is your time worth? And if you're a financial advisor, sure, you may have access to some of the information that's included in the newsletter, those things that are not proprietary. But what is your time worth? I am aggregating a tremendous amount of information into one place for pennies a day. So ask yourself, even if you could look up some of the information, of course, the information that's not proprietary, what is your time worth? Wouldn't it be helpful to have all of this information aggregated into one spot and delivered to your email in basket on a weekly basis for pennies a day? So again, a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. To get started, just go to https://simplemarketsignals.com.